Good morning. Welcome to Beyond the SEAF Model. I'm Jack Kosar. This is effective for the week of April 21st, 2025. Let's get started. SEAF signals for this week. We have retained financials and utilities and swap out staples for real estate. Real estate comes in at a 15, so kind of more of a header on the consumer staple side of things versus super strength coming out of real estate. But as we'll see in the heat map in just a second, real estate is green across the board and relatively consistent. Financials resume continuing strength with their overall score of 5, and not to be outdone, utilities with a nice strong score of 7. Technology looks to have been rebuked after that 1 week kind of increase, and consumer staples did not fall as hard as technology did. Seeing a little bit of life of energy in terms of the trading week. We'll show you why that is consistent with the way energy has been acting, but maybe not something to bite on, and much more. So heading into our heat map. Heat map looks relatively strong. It looks like the market has realigned itself, is consistent with these kind of these top sectors. Financials really showing off to interest rates, utilities as a more of a defensive play, and floating with real estate and consumer staples up here in the top 4 to round it out. Real estate taking a little bit of, consumer staples taking a little bit of a break. And like I said, energy showing some strength. Overall, looking at the one, with energy. So energy is coming in at a 0.22% with its, in terms of its weekly flow increase, which isn't overly strong relative to our studies. As I mentioned ad nauseum, 0.4% increase on a trading week in terms of its asset flows via our calculations. Kind of shows a really significant move. We have 0.22% for energy at 1, 0.17 increase for the trading week in financials at 2, and then a 0.17 increase for utilities, again, for the trading week, meaning we weren't as strong in conviction for any one of these particular sectors. Other thing to note was we were technically net down on all asset flows, so if you check just the 11 sector spiders, added up all the flows, we were net down 0.082%. So what was that telling me? It was a little bit of a shortened week, going into a longer holiday weekend. And in general, managers, investors were not looking to put on anything overly heavy in any one particular direction. They did not want to get caught off sides over the weekend. Other thing to kind of note and just highlight a little bit why this works and what we're looking at. But here I have a chart on top. This is the total. If you added up all the total net assets for all 11 sector spiders to come up with one overall number, that was what we have here on top. On the bottom here, this is the S&P 500. Price chart. So what I wanted to show here is that since February 21st, we have broke the 21-day moving average regarding the assets in the 11 sector spiders, and we have been below it since that time. We have attempted to retest that 21-day moving average on 325 and 4-2 as well. And just a little bit of a side note, we were out on CPM on the open April 3rd. So but what this chart is showing me, and you can see here in the price chart here on the bottom, is as we've had a decrease in these assets under management in the 11 sector spiders, we've also been below the 21-day moving average in the relative performance versus in the price chart for SPY. So just showing here is that these total net assets, when it regards to money coming in and out of the 11 sector spiders, does have some correlation with price. Is it perfectly correlated? No. Is it a predictive tool every single time? No. But if you can look at this chart, you can see as we're above the 21-day moving average on our assets under management for our 11 sector spiders, we tend to be above our 21-day moving average as well on our price chart. So just showing a little bit of that consistency between the assets under management that we look at for our SEAF model and its correlation to price. Now, going into our rainbow charts, financials looking relatively strong, extremely strong, uptrend in the relative performance part of the chart. We are also seeing some nice upper favored out of financials. It has been hanging out there for a little bit of time, and we've seen that nice relative outperformance. We're coming up a little bit on some resistance in the relative outperformance versus SPY for XLF, but as of right now, seeing some strong flows in all three time periods. Financials is a good place to be relative to the broader market. Energy, wanted to show energy, and I like to do this every so often, is when we see a sector that shows a lot of weakness, both in its tactical weakness in its tactical month and strategic quarter, and then we'll see this bright of life, a one in its trading week. As you can see here, all that did is took energy from the deep void at 33 that it was last week up into neutral. We have a little bit of relative outperformance from that bump, but we really do need to see some sustained flows. Energy has been a unique case in the sense that it looks like somebody's heart monitor here, where we kind of blip up into favored. Those moves come on 1 or 2 week increases into the assets and the assets under management, and then they disappear. We haven't had those sustained trends in energy that we've been looking for. Very much been trading in a box, really going back to September of last year in terms of its relative performance versus SPY. So, we are not biting on this 1 week energy flow. We would need to sustain several weeks and really, for energy, get into that upper favored so we don't get head faked again in its relative performance. Again, while showing a slight uptick, still very much on a broader downtrend in energy. Now off to utilities. Utilities, again, looking relatively strong, sitting in that nice upper favored ranking that we like to see. Again, another strong set of flows. Wasn't quite up to the standards we look for on a trading week, but it was good maintaining flows for something that was already showing strength across 3 time periods, seeing that nice relative outperformance, playing with this upper resistance that we see in the relative performance chart, but really nice strong uptrend in utilities for its relative performance versus SPY, and showing some nice strength and continued flows in utilities. Real estate came in. Now, as we'll see, real estate is sitting here on that kind of lower favored ranking. We have been flirting with that lower favored ranking for a couple of weeks now. Finally getting its a little bit of time to shine. Seeing some nice uptrend in relative performance versus SPY for real estate, approaching this resistance level here in the bottom half of this chart. We would definitely need to see some sustained upper flows in real estate, as we're sitting at 4, 5, and 6 respectively in the trading, tactical, and strategic quarter. On the positive side, though, is we do like to see that positive skew, going from something that is not weaker, but generally in the weaker sense, and moving into a position of strength. So going from 6 to 5 to 4 does show some positive momentum over the several time periods. We are seeing that relative outperformance show up in the bottom half of the real estate chart. So looking for real estate to be a good place to be. We'd also like to see some sustained flows into real estate, get in that upper favored to really drive this relative outperformance up higher. Last but actually least this week, technology. So technology did come up last week. As I mentioned, we would want to see multiple weeks of sustained flows out of technology, that a 1 week kind of intervention wasn't going to push us to where we needed to be to create a signal. We appear to have been rejected here for technology. So technology came up into favored and then right back down to avoid with the outflow week. Again, flows were relatively tame for this particular last week. Likely to do with, several factors: uncertainty in Washington, long weekend, and kind of a combination of wanting to not make sure we're getting off sides. But technology resumes its downtrend in its relative underperformance versus SPY. We're back into a deep void. Not as deep as we can go, but we're headed in that particular direction. Technology, a good place to avoid at this moment. That is all I have for this week. I look forward to breaking down the SEAF model with you all next week, and thank you.